Welcome everybody. Good afternoon, and thank you for making the trip out here. It's the 2015 Annual General Meeting of Cromwell Corporation Limited and the General Meeting of the Cromwell Diversified Property Trust. I will be saying things like that quite a lot, but because we're a stapled security, we have to actually talk about the trust and the company in one, because we have this meeting which is actually for both. It's just as confusing as it is to all of you as it is to me and as it is to everybody else, so don't worry about it too much. Before we start the meeting, I'd just like to introduce you to my fellow directors who are here today. There's Paul Waitman, next to him is Richard Foster, next to him is Andrew, and next to him is Robert Puller, next to him is Michelle McKellar, and finally Jane Tongs. And I'd also like to just welcome, we have some of our visitors here from, people who work for us in our new acquisition from Valad in Europe who are here today. So I'd just like to welcome, where is he? Marty McCarthy is actually very much part of the Australian business now. He's back home here. To David, Kirby and Claire at the back over there, who are both here from London to be with us today and to spend some time in the business again. Mark Wayner, who is based in South Africa, unfortunately couldn't make it, but his alternate, where is Jeff? Oh, there's Jeff, sorry. Sorry. Jeff Cannings is here in his place. Also, I'd like to welcome Nigel Badders, who's from a partner at Pritchard Partners. Where's Nigel? Down there. And later on, you'll have an opportunity if you want to ask any questions of Nigel, who's our auditor, and make sure anything that concerns you, you could let him know about. We're now going to open the formalities as well, and I've been informed that there is a quorum for each meeting, and that therefore formally declared open. I'm going to read from a set text for the chairman's address, because it has to be printed on the at the stock exchange and put onto our website, and we kind of have to make sure we say the same thing. So I will read from it, and excuse me for doing that. Cromwell's key objective is to provide a secure and growing distribution to our security holders, and it was pleasing that we were able to continue to increase distributions per security by 3.1% to 7.86 cents per security in the 2015 financial year. During the year, we saw substantial competition for quality commercial property assets in Australia. Face yields remain relatively attractive by international standards, and offshore capital continues to pursue opportunities here aggressively. This has resulted in cap rate compression across all asset classes, particularly in prime office markets on the East Coast. In response to the high level of investment demand and accompanying market noise, Cromwell has stayed true to its well-established strategic objectives. Our balance sheet property strategy remains consistent. We continue to internally manage a property portfolio that provides a solid base of dependable and defensive earnings, balanced by a smaller portfolio of active assets that can deliver our outperformance. During the year, we sold a number of non-core active assets at premiums to their book values and to what we consider to be their intrinsic values. The sales proceeds have been firstly recycled into new value-add opportunities, secondly used to reduce debt in accordance with our stated gearing strategy, and finally held in cash for future opportunities. We have been careful at this point in the investment cycle not to acquire or promote assets that may not offer appropriate risk-adjusted returns. The rigorous assessment of potential acquisition opportunities and maintenance of investment disciplines in a consistent manner manner are of critical importance in ensuring that the interests of our investors and security holders are protected. Investors and capital are increasingly global, and therefore we made an acquisition of Valab Europe in March 2015, which is an important initiative for Cromwell. The acquisition transformed Cromwell into a global real estate investment manager with offices in 15 countries and investors and capital providers in many more. The acquisition fits with our stated strategy of growing funds management with a long-term target of delivering 20% of our earnings. We believe an 80-20 balance between direct investments and fund management earnings will be beneficial in helping deliver predictable, growing distributions to security holders through the property cycle. Importantly, a global platform allows us to build a network of international capital investors and to be in a position to provide them with opportunities that meet the objectives of their investment mandates. We are excited by the opportunities available to grow this part of our business. I'd also like to take this opportunity to thank our CEO, Mr. Paul Waitman, and all the Cromwell staff for their collective efforts this year. I would also like to thank my fellow board members for their support, and in particular, I'd like to acknowledge Mr. Robert Puller, who will retire from the board today, and also Mr. Daryl Wilson, who resigned in February of this year. Daryl's in the audience. I saw him earlier. There he is. Daryl joined Cromwell in August 1999 and had primary responsible for the finance and funds management functions. Robert joined the board in 2002 and has been an active contributor to to the board and various committees. Both Robert and Daryl have contributed enormously to Cromwell's success over the years, and we wish them well with their future endeavours. If everyone would just join me in giving them a little round of applause to thank them. Finally, I'd like to thank you, our security holders, for your ongoing support. Cromwell exists for your benefit, and I look forward to working with the whole Cromwell team over the next year to continue to serve your best interests. I'd like to hand this over now to our CEO, Paul Waitman.
Thanks, Jeff, and welcome security holders and guests. Cromwell's board and management team were pleased with the performance of the group in 2015. Our operating profit was robust, and it reflected our clear focus on the active management of our balance sheet property portfolio and in growing our funds management business. During 2015, we saw increases in property management segment income, property valuations and wholesale funds management earnings as a result of the $207 million acquisition of Valab Europe. Debt interest costs in 2015 also tracked lower than in previous years. We were again able to increase distributions per security by 3% to 7.86 cents per security, up from 7.6 cents per security in the previous year, and in line with the guidance that we'd given to the market. Income from our core investment segment increased 2.2% to $141.6 million. This was a robust result given soft rental market conditions in a number of markets. Overall, the property portfolio continues to exhibit a very strong tenant profile, with government-owned and funded tenants contributing 45% of rental income, and listed companies or their subsidiaries a further 32% of rental income. Property portfolio valuations increased by $25.4 million net of capex and incentives and the portfolio had a weighted average lease expiry of 6.5 years and a vacancy of 5.4%. I think, as we've consistently said, we maintain two different pools of assets on our balance sheet, and we have separate strategies for each pool. The core portfolio consists of 14 assets worth approximately $1.6 billion, with a weighted average lease expiry profile of just under 8 years and about 8.7 years if we proceed to fully document arrangements that are currently the subject of heads of agreement. These assets display defensive characteristics and have delivered a weighted property ungeared internal rate of return since acquisition of 13% and an average valuation uplift over costs of 11%. Assets in our core portfolio have either been acquired at attractive prices at the bottom of a property cycle or are the products of repositioning of an asset from our active portfolio. The active portfolio consists of 11 assets worth approximately $600 million, with a shorter WALE of about 2.4 years, slightly higher if we convert some of our existing heads of agreement into final executed lease documentation. These assets offer opportunities for us to deliver outperformance, either because of the prices at which they've been acquired, because they've been bought over-rented with alternative use, or because they can be improved, repurposed, or repositioned to generate capital profits. During the 2015 financial year, we were a net seller of assets, selling 2 assets for $244 million and a further 2 assets for an additional $99 million after the end of the financial year. As Jeff mentioned, the proceeds of these assets have been used either to reduce debt or to be recycled into other value-adding opportunities, or are currently held in cash awaiting the right investment opportunity. Wholesale funds management earnings increased to $2.6 million as a result of increased activity from our Australian wholesale fund, Cromwell Partners Trust, and from a part-year contribution from Valad Europe. The acquisition of Valad Europe has provided Cromwell with ownership of an established, well-respected European wholesale funds management business that has a broad range of international, institutional, banking, assurance, sovereign wealth and pension fund customers. It's a strong cultural and strategic fit with Cromwell. It has a good strategy, good track record, and a high level of recurring fee income. The business was acquired at an attractive multiple and has been funded by euro-denominated convertible bonds to manage the currency risk from the investment. Most importantly, the acquisition provides us with local real estate capability in 15 countries and access to a broad range of international capital providers. Capital flows are increasingly global, and we want to provide investors with a platform that can meet the objectives of those capital providers. We'll focus over time on growing our funds and our footprint to provide a platform to accommodate that. Retail funds management earnings were $1.4 million, down from $3.5 million in the previous financial year, mainly due to lower transactional fees. These lower fees reflect our caution in relation to asset acquisitions on behalf of investors at this late stage of the property cycle. Assets under management from the group's unlisted direct products and interests in Phoenix portfolios, in which we have a 45% interest, and New Zealand's Oyster Property Group, in which we have a 50% interest, still showed solid growth, increasing by $300 million to $1.5 billion. During the year, the funds management team scooped 2 awards at the 2014 Professional Planner Zenith Fund Awards, picking up the A-REIT Award for the 2nd consecutive year and the Direct Property Award for the first time. In New Zealand, the Oyster Property Group continues to perform well. 3 syndicates, the New Zealand Racing Board head office in Wellington, Cardinal Logistics Distribution Centre, and the Albany office building in Auckland, all closed oversubscribed during the year. Assets under management grew by 18% to over 733 million New Zealand dollars, reflecting the strong local demand for for investment product. I'd also like to take the opportunity to mention the recent sale of the ATO Box Hill building. As many of you know, we received an unsolicited offer for the building and put a potential sale to Box Hill Trust unit holders who voted in support of a resolution to sell. The building was subsequently sold in September for $156 million, 18.6% above the March 2015 valuation of $131.5 million. Cromwell Box Hill Trust unit holders' original $1 investment in December 2012 earned 21 cents per unit in monthly distributions over the life of the trust, and unit holders received a special distribution payment of $1.33.5 per unit after settlement. Cromwell continues to adopt a conservative approach to capital management. Group gearing as at 30 June was 45%, up from 42% from 12 months previously, largely as a result of the issue of the convertible bonds to fund the accretive acquisition of Valad Europe. Post 30 June, asset sales have reduced that gearing level back to 42%, and property portfolio gearing, which removes the impact of the convertible bonds, was 36% or 32% on a pro forma basis as a result of post-balance date sales. This gearing level is towards the lower end of our target range and consistent with our previously stated gearing strategy. We've hedged future interest rates through an interest rate cap to May 2019. Our debt is well diversified with a weighted average debt expiry of 3.5 years and with 64% of debt not expiring until after the 2019 financial year. The debt platform and hedging program initiatives are designed to provide management with a high level of comfort on the quantum and cost of debt over the short and medium term and provide certainty for future distributions. Australia now ranks as one of the world's largest destinations for commercial real estate investment, with Sydney the 4th most popular global gateway city behind only London, New York and Paris when considering international flows. And Melbourne's not too far behind Sydney. This popularity has been driven by the expansionary policies of governments around the world through quantitative easing, and these policies have led to record low interest rates globally and an unprecedented demand for yield. Ultimately, we believe these policies are unsustainable and will eventually, at some point, have to change. In the short term in Australia, we expect that quality property assets, particularly those with long leases, will remain in high demand. Growth should slow during the year, but will remain robust in Sydney and Melbourne. We're also seeing some improvement in the office leasing market in these two cities, but the other capital cities remain soft. Our tenant profile partially insulates us from these conditions, but we continue to carefully manage and de-risk our lease expiry profile. In Europe, investment volumes are up. Investors are increasingly looking for value-add transformational opportunities in secondary locations across all market sectors. With 22 offices in 13 countries, our European business has the local knowledge and expertise to meet these requirements. Our strategy remains consistent. We continue to look at opportunities and adjust and strengthen our portfolio. We've got a strong balance sheet with low debt and sizable cash reserves, leaving us well positioned to take advantage of future value-adding opportunities as and when they arise. We forecast 2016 financial year earnings to be not less than 9 cents per security and distributions to be not less than 8.1 cents per security. These expectations are based on conservative assumptions on the level of transactional revenue, including promotes and performance fees in our funds management business, and on the returns from cash reserves, which are assumed to remain on deposit for the full financial year. I'd like to thank the board for their support over the last 12 months and to acknowledge the hard work of all of our staff. With over 330 employees and 30 offices in 15 countries, success is very much the product of a team effort. Thank you.
All right, so now we need to do all the formal business. So, as I said earlier, we're actually a stapled enterprise consisting of Cromwell Corporation Limited, which is referred to as the company, and Cromwell Diversified Property Trust, which is referred to as the trust. Since Cromwell Property Group's securities are stapled, the meeting will be held concurrently. You will see that there are some formalities we have to follow. Those security holders and proxy holders who have registered to vote will have received a yellow voting card. Non-voting attendants should have received a blue non-voting card, and visitors should have received a white visitor's card. A number of proxies have been received, and in line with the requirements of the Corporations Act, details of all proxies in respect of each resolution were recorded in the minutes, irrespective of whether the motion is voted on by show of hands or on a poll. Before each resolution is discussed, I'll advise details of the proxies which have been received. You should note that for each resolution, I intend to vote undirected proxies in favour of those resolutions. I take this opportunity to note that each director who holds Cromwell Property Group securities has voted in favour of all resolutions, except, of course, where they are excluded under the Corporations Act or the Australian Stock Exchange listing rules from voting on a particular resolution. Shortly, security holders will be asked to vote on the resolutions to be put to the meeting. You will have an opportunity to ask questions or discuss the specific resolutions. Resolutions 1, 2 and 3 relate to the company only, whereas 4 relates to the company and the trust. Unless there are objections from security holders, I propose that the resolution 4 be presented to this meeting and discussed and voted on concurrently rather than separately for each of the company and the trust, as this saves repetition. If any security holder considers that resolution 4 should be considered separately by shareholders of the company or unit holders of the trust, I can adjourn the relevant meeting to have the matter considered separately. I move to the proposal that resolution 4 be discussed and voted on concurrently. Could I have a seconder, please? Yes, thank you. All those in favour? Anyone against? Nope, thank you. Anyone present who is not a Cromwell security holder, proxy holder, rep is welcome to attend and listen, but they cannot address the meeting or vote. No attendee can make a tape or video recording or take photographs of the proceedings without our consent. When rising to ask a question or make a comment, please show your voting card, whichever colour it is, state your name and whether you're a security holder either in your own right or whether you're attending on behalf of a proxy on behalf of some other security holder. The notice of meeting, which was sent with the notice periods required by the Corporations Act and the respective constitutions of the company and the trust. I move that the notice of meeting be taken as read. Could I have a seconder, please? Thank you. All those in favour? Anyone against? Nope. Thank you very much. We'll take it as read. Minutes of the previous general meeting are available, and there's a signed and true correct record here, and if anyone wants to have a look at them, please feel free to do so. So let's move to item 1, the consideration of our reports. The first item on the agenda is to consider Cromwell's 2015 annual report, which contains the financial report, director's report, and auditor's report of the company for the year ended 30 June 2015 and has been made available to all security holders. This resolution for consideration by the meeting is intended to provide an opportunity for all of you to raise questions on the report and on the performance of the company generally. I now invite discussion and questions in relation to the 2015 annual report. If you wish to speak or raise a question or comment, please wait, acknowledge your name, etc. You'll get a microphone from over there and we'll go. Are there any questions on the annual report, please? You're disappointed. Any questions? Raise your hand. The mic's waiting. You don't disappoint.
I noticed how the chairman looked at me.
Yeah, you better use it.
Andrew Gray, on behalf of Andrew Gray and the Argus Super Fund. I've got a couple of points. The first one, I'm pleased to note when we pulled up in a taxi outside the building that the columns and the entrance has all been finished and looks a lot better, and that should help you find tenants for the vacant space in the building. Secondly, I would like to compliment you and particularly Paul Waitman and the board for, I think, a very good result in what was not an easy year. And I think that in addition, that the forthcoming year will really test your mettle. And if I could comment on a couple of matters raised in the report, it's going to be difficult to hold this and read what I want. There's the lady. The people that are directors have got the advantage. They're sitting at the table. I'm on section 26, property and internal funds management, which showed a loss of 607,000 compared to a profit of 2.8 million. The CEO has already commented on that, but in that same paragraph I'm reading from, it said, this segment is expected to return to profitability in 2016. That's good news. The next paragraph is external funds management, where the profit reduced from $3.45 million to $1.4 million, but it doesn't say anything about that that's going to return to profitability in 2016. That's just a comment. I'm interested in what's happening in Europe, and I'm rather concerned, having just arrived here and enjoying your hospitality with a cup of tea and some very nice sandwiches, and a lady said to me she was concerned about Valad in Europe. Another shareholder came up to me and said, oh, hello, glad to see you here. I've got a piece out of the paper. You might like to comment to the board. And this was from one of the press saying, sell Cromwell, and giving a couple of reasons why. But I think our main concern in 2016 is going to be the bedding down of Valad, and I'm rather concerned with what's happening in Europe currently. And the thought went through my mind, where do we stand with all these buildings that we're managing in terms of ISIS and insurance against terrorism? In years gone by, I don't know whether it's changed, it was impossible to get insurance against terrorism. How do we stand if they suddenly decide to take umbrance against Cromwell and blow up one of your nice buildings? I thought maybe the one in Orleans in France would be a very good one to start with. And what would be the effects? And what are your provisions for what's happening in Europe?
Well, firstly, let me just say that thank you for your kind comments and all the rest of it. If you asked me where do we stand, I could tell you what Mr. Obama, Mr. Turnbull says, shoulder to shoulder. No, I won't say that. But the truth of the matter is that we have an enormously good team in Europe. We do have a team in Paris, which we were happy that when all the trouble happened, we made calls and to find out. I mean, Paul was recently there, so he met a lot of the people. Obviously, we've got some of the leaders of the business here now, so everyone was very distressed, but thank God, all our people are okay, etc. But the bottom line is it's a troubled world, and you've got to just carry on business as usual. To the extent one has insurance in the normal course, you have insurance in normal course. Our European business does not have buildings that we actually own, per se. We manage, it's a funds management business where we have an enormously talented team of people who manage buildings on behalf of other institutional type investors, private equity investors who invest in Europe, in the Euro area. There are parts of Europe which at the moment aren't as inverted commas expensive as places like Australia, or for that matter even England, and so it's an area where a lot of capital, whether it's from the United States or from Asia, is coming, and our people can help look after that capital for those people and get their returns on the buildings they manage on their behalf. If we sell it at a profit for them, we get a commission on that. If we buy it at better things, we get a commission on that. We get a management fee for managing the property for them, and they seem to be very happy customers with the excellent work that our people in Europe are doing. So first thing to put your mind at rest is that whilst we make sure we treat the properties as if we own them, because that's why we do such a good job over there, we don't actually have the risk of ownership in them. We have the risk of everything that we treat it, like we do the good care of those people anyway. But so in that regard, all the normal risk strategies that one would normally take with one's assets are taken there as they are anywhere else in the world. I don't think I can, I think I've touched on the things you mentioned about Europe, but I don't think I can add more. Paul might want to add to that.
Thanks, Andrew, and thank you for your suggestions on the columns last year. I think our crack facilities management team went into action the next day, so your concerns are always addressed and noted. I think as Jeff said, in terms of Europe, we have a management business there, so no direct asset exposure. But the investment in Europe is very much directed towards capturing exposure to capital across the world. And because capital is increasingly being invested globally, we've got to be on the ground where, firstly, that capital originates, and secondly, where it might be applied. So it's an extension of the business that we have. It's not our whole business, but it's something that we can invest in and grow to add to the earnings streams that Cromwell has. It's not an indication that we're going offshore to invest in property, as Jeff said, but it's a recognition of the fact that money now moves around the world, not just across Brisbane or across Australia. I think in terms of the sectoral profitability that you referred to, very much the difference between 2014 and 15 was the fact that we weren't promoting retail syndicates because we just can't see the value for our investors. So rather than chase earnings from a sector of the business that would disadvantage our investors, we just park it for the time being until conditions are better.
Yep.
And I think, the advantage of having a business that has a number of different revenue sources is that through a property cycle, some revenue sources will be strong, some revenue sources will be weak. But if you can have a diversified earnings profile where you're getting revenue from a range of different sources, you're more able to manage the volatility in a cycle and provide a secure growing distribution stream to investors.
Any other questions? Or down there first. Sorry, we'll come back to you, Andrew, if you don't mind just putting a pin in the question. Sorry. Yes, sir.
Graham McAfee from Canberra, and my wife and I are up here as investors. Now, I'm a bit concerned about page 9 of the annual report, where it shows assets under management and so forth, and it looks as if most of it is about somewhere of the order between 57% and 58% of assets under management by the company are now in Europe. So what, mostly that's associated, different sort of business as you explained. But what I'd like to know, and of course maybe it's a bit early yet, but do you have any projected income, outgo, less expenditure? Therefore, you mentioned 8.1% their distributions. Now, I'd like to see the two things side by side. Here's Cromwell without Ballad, here's Cromwell with Ballad, and balance sheets for each and returns for each, so we can see whether one is supporting the other.
Yeah. So in our balance sheet, in the balance sheet, you won't see any of the assets we have under management that we don't own. So the assets we own, you'll see in our balance sheet. The assets under the management is actually the assets which the funds we take on behalf of other people who aren't Cromwell shareholders, people who go into those separate syndicates, funds or whatever. Those are the assets under management that when we talk about those. And then what we actually own in the balance sheet, you can see in the balance sheet. As Paul mentioned earlier in his talk, and I think I touched on it as well, that basically we're aiming over time to have roughly, at the moment we aren't up to 20%, but to have almost 20% of our income coming from fees which we'd earn on behalf of managing assets on behalf of other people. 80%, however, and at the moment it's a bit more than 80%, comes directly from the rents we collect on our own properties. And those are all, as we speak, in Australia.
What's the yield on both? How does the Ballad business yield compare from our distribution point of view, as well as how does it compare vis-a-vis the Cromwell actual hard property?
So if you think about the Europe business as contributing about 12% of your total distribution, and Cromwell rent contributes about 85%, and about 2 to 3% comes from our Australian retail funds management business. So we have if you think of our business as having an enterprise value of about $2.8 billion, we have about 200 million invested in Europe, and we have the balance invested in Australia. And from that money invested in Europe, so Europe is funded with a convertible bond that costs 2%, and we get about a $25 million return on that. So let's say it's 15% on a 2% cost base. The Australian business is funded by a combination of debt and equity. The debt costs us a bit over 5%, and the equity is currently trading at about 8%, say. So, you know, we've got effectively $2.6 billion worth of combined debt and equity, generating about $140 million net, and we've got $200 million worth of hybrid, generating about $25 million net.
If you can put that just in simple terms for somebody who's only got a diploma of agriculture, what is the yield on the money that we have put in, or the Cromwell has put into A, which is the pre-Ballad thing, and the
all right. Well, we get about
yield on both.
We get about a weighted average yield on our assets at the moment on their valuation of about 7.5%.
That's Ballad.
No, that's Cromwell real estate assets, and we're getting double that effectively on our Ballad, the capital that we've contributed for Ballad.
The big advantage of a funds management business is that you don't actually use your capital. You're actually getting fees out of other people's capital effectively. So it's not, you can't really look at it on a yield basis way of investing. So, any other questions? Sorry, yes, sir. I think she's coming round with the microphone here. So 1 second, sir.
Thank you, Mr. Chairman. Malcolm Badgery from the Australian Shareholders Association. I represent 38 holders with 1.3 million shares, including myself. Although, I apologise that I'm also going to ask questions about Ballad, but it has been a transforming acquisition for the company, so I suppose people are interested in the subject. The first one is a sort of a general one. Valad has a sort of a negative connotation in Australia or in the property world. Is the European Valad anything to do with the Australian Valad? And either way, would you consider changing the name? Is it a negative?
Well, what you say is partly true and partly not true. So in Australia, certainly because there was a company called Valad that owned a European business, which was Valad Europe, got into a lot of issues and troubles. And when it got into those troubles, the part of its business which was the most saleable and the jewel in the crown was its Valad Europe business. So the good news is, out of the bad one, the good part was the Valad Europe. As regards the name, yes, in Australia, yes, it has those connotations because it got into trouble, but the reputation of Valad in Europe, on the other hand, is a reputation of quality management, and therefore the clients they have are some of the very best institutions and funds in global capital, because they have a very good name in Europe, because our staff in Europe, our employees in Europe are outstanding people, and as a result, they're the reflection of the name over there.
One of the features of Cromwell, which Ross McGlade brought me up to speed on, is your internal management of the assets that you manage here, even if you own them. But do you have internal management in Valad, or is that outsourced to?
No. In Valad, we are the external manager on behalf of other people's assets. Whereas in Australia, not only do we own them, we manage them, we're internally managed completely. So we aren't the manager on behalf of other people's assets in Australia on our balance sheet. But for example, if we have a fund, which is at this point, as I say, is a very small part of our business, even in Australia, that fund would have investments from certain investors, including a lot of our shareholders who want a particular ownership in a particular asset, which we manage on their behalf.
Yes. But in Australia, you collect the rent. That is, Cromwell collects the rent.
Correct.
And takes its fee and sends it off. So that do our people manage the buildings in Europe and collect the rent, or do we outsource that to Rain and Horn and Richard Ellis? Yeah.
That you it's not worth doing. So it depends on the asset and on the mandate and on the fund and on the country.
Yeah. Where there's scale and where it's worth it, there's a mix of what you need to do.
All right, and now my final question on this subject relates to the convertible bonds. I take it that they're convertible at the option of the bondholder in 5 years' time, unless there's a takeover or unless certain events occur. But in the ordinary course, you wouldn't expect them to be converted within 5 years in the ordinary course, or is there a reset, what they call a reset date? And also, do you expect if you're growing, if the share price grows by 4% a year or whatever, and earnings and so forth, do you expect those bonds to be converted by a rational bondholder, or are they likely to want their money back rather than securities in Cromwell Corporation?
I can talk to that.
I'm happy.
So the convertible bonds were issued with a 5-year tenor, so they've got about 4.25 years left to run. At the date of their issue, there's intrinsic value in the optionality, so the fact that you've got a bet in the future, which tends to value the bonds in the hands of their holder at a premium to their conversion price. So our conversion price was around $1.15. On the date of issue, their value to a holder was about $1.37. So that would be the break-even price at the commencement of a 5-year term, at which they'd regard fair value for what they've got. As that term expires, the value comes closer to the redemption price, which tends to suggest that most people will make a decision towards the end of the 5-year period. Now, the bonds are repayable if not converted at 5 years, but they can be converted at any time. So we could end up with theoretically 150 million euros or $200 million sitting on our balance sheet. It's unlikely that that'll happen because they're worth more than the price at which they can currently be converted into ordinary Cromwell securities. Now, because they also bear a coupon rate of 2%, it's more attractive for us if they're not redeemed because we've only got to service 2% on those bonds, whereas if they're converted, we've got to pay normal distributions. So as we get towards the end of the term, we lose the benefit of that cheap money. But for most of the 5 years, we've got an investment that's giving us a very high return at a very low capital cost.
Any other questions? Any more? Oh, Andrew, sorry.
Thank you very much for the opportunity. I still didn't get a definite answer whether the buildings which you manage for Valad in Europe, whether they have or can secure insurance against terrorism. A yes or a no?
So, Andrew, in most jurisdictions, there's a government sovereign guarantee of terrorism damage. That's the case in Australia. In most jurisdictions, that's the case. It's generally impossible to get terrorism insurance. Depending on the quality of the sovereign nation, it is or isn't available, but generally governments will underwrite terrorism insurance as a risk associated with their sovereign status.
Thank you for that. The chairman kind of led me to believe, well, it wouldn't matter, we're only the managers.
That's right.
But I'm envisaging a situation where one of our prized buildings in Europe is blown up. The tenants are unhappy.
Particularly if they've been blown up.
Yes. And they're inside the building. But it's got to have repercussions in terms of our commission for possibly 3, 4, 5 years.
Well, it's an it's
operational
not
risk.
only loss of the building, it's loss of the management of the fund.
Yeah.
So yes, there's an inherent operational risk in any funds management business that you'll lose your fee revenue.
But you're content that we've got enough spread across the
It's
various
a widely
portfolio.
diversified business, both in terms of funds, properties. You know, there's over 3,000 tenants across Europe in that business, so we're pretty comfortable that we're not going to lose a significant number of them. Look, force majeure events are an event of reality
Which
in
come
building
from-
ownership, business operation. You insure against them to the extent that you can, but you can't get rid of it completely.
Thank you for that. My final question is a historical one. Could someone please tell me how the unit holders from the exhibition building in Melbourne, how did they finally finish up? What did they get back out of their original dollar?
It was in a wider fund, so I can't, off the top of my head, I can't tell you. We bought the asset, I think, at about $90 million, which was, in our view, in excess of its market value. Out of the fund, as you recall, CPF investors were offered a rollover into Cromwell. That rollover, I think from memory, was at 68 cents.
Yeah, close to 70.
So they've had a pretty decent uplift since, if they've held their Cromwell shares.
Thank you for that. I remember the chairman saying 2 or 3 years ago when I asked the question as to, he said that they were now returning a dividend. And I said, well, what dividend are you returning? And it was 1 cent. That's the question now. So would I be correct in assuming that somebody had put all their life savings into that exhibition fund would have got back 50% of their money?
It depends whether they've sold. If they've held all the way through, I think we got down at one stage to about a 25 cent NTA. If they've held their Cromwell shares and they've received over the course of the last when we do that, 4 years, a distribution at 9%, and they've got a 50% uplift on their original investment, then yeah, they've got a substantial proportion of their funds back.
Thank you for that. And a final thought in relation to the year just finished. Our net tangible assets per share fell from 75 cents, I think, from memory, to 63 cents, and the price goes up.
Because the net tangible assets relates to the actual buildings you own. When you buy, for example, a business like Valad, it's not counted. It's counted as goodwill. Goodwill is not tangible, therefore it's not a tangible
And
asset.
goodwill
So
can disappear very quickly.
and you better not buy any shares on any company, because some of them don't have any NTA. They only have, but they can be worth billions of dollars. Like, for example, Facebook. The point I'm making really is, I'm joking, is that we're a company that has funds management, which isn't measured against its capital. It's measured on effectively an earnings multiple, and we have an NTA, which is the actual underlying value of those businesses, of bricks and mortar things you own and other types of assets. And in our case, the NTA you see relates to the entire business.
Well, wouldn't you like to see the NTA a lot nearer to our market value price?
Not if it meant our shares had to fall to make that happen.
Thank you for that.
All right, if there's... we didn't get any written questions, by the way, so there's nothing else I can tell you about that. If there's no other questions, then I'll move on. Is that any more? There was no votes needed on that one, was there? Any questions for the auditor? I said in the beginning, if anyone has, he's available afterwards. Do you want to grab him? But if anyone wants to ask in a public forum, feel free. Nope. Okay. The second item is the re-election of Mr. Richard Foster as a director. There is commentary relating to Mr. Foster in the notice of meeting and Cromwell's 2015 annual report, which we've already taken as read. The resolution reads that Mr. Richard Foster, who retires by rotation in accordance with the Constitution of Cromwell Corporation Limited and offers himself for re-election, is re-elected as a director of Cromwell Corporation Limited. Here are the proxies up on the screens. Would any security holder like to speak in relation to this particular resolution? Yes, sir.
Well, thanks, Mr. Chairman. Firstly, I'd like to say the Australian Shareholders Association is advising its members to vote in favour of this resolution. There does seem to be what I consider a rather unusually high vote against, and I wonder if any of the proxy advisors had something to say about this nomination.
To the best of my knowledge, the proxy advisors were in favour. Where's Rossi or Lucia too? I didn't get any information that they weren't.
Anyway, well, unless, I mean, no, but the other thing, the serious point I was going to make is that I noticed that you declare, or that you've determined that that Mr. Foster's an independent director, and that is something which I just find hard to accept. I mean,
Yeah.
Richard is one of the Cromwell legends, and he's been with Cromwell for 17 years, and actually it said at one stage he was executive chairman. Was that true, or you were executive chairman?
Yeah, I was executive.
Richard hasn't been an executive, a paid staff member for how many years now, Richard? 5 years, and if you come to one of our board meetings, you'll discover he's fiercely independent.
Well, look, I have no doubt about that. And it's just that, I mean, this, in fact, I'm more of an outcomes than process fellow, but the Australian Shareholders Association seemed very caught up in all this corporate governance. So I just raised the question because, but you went out of your way to declare him to be an independent director. And so I just thought I'd raise the question.
We were asked if he is, so we...
Enough said.
So
all right,
we said
thank
he
you.
is. However, anyone who has votes because people have been there too long, or they feel age, or any of those things, is, you know, that's people's prerogative. I read a lot about in this morning's paper from Jerry about people who didn't like his family being directors and all the rest of it. But you know, so what can I say? People don't have to own shares in companies they don't like. What can I say? Anybody else have any questions? I'll tell you that Richard's an outstanding director. He understands the company really well. He knows property in Australia better than most people, and he's a great asset to the company and to all of us as security holders. I move.
I would like to second.
Thank you.
It gives me a sense of confidence to see him sitting there every year.
So,
looking as well as he is looking.
so I would like, yes, sir.
Mr. Chairman, Richard is getting a bit grey around the edges, but so I think are all of us. And I don't think the greying of Richard's hair has anything to do with the state of his mind. He's always been a good director, and he's been a huge support for Cromwell and its shareholders. So it doesn't worry me that there are what I would consider 10% of uninformed people who consider he's not effective as a director. My only comment is they should get themselves informed and read the history of this company and the enormous contribution which Richard has made. Thank you.
Excellent. We agree with you. Yeah. So I move that Richard be elected. Anyone second? Thank you. All those in favour? Anyone who dares be against? Congratulations, Richard. Unanimously re-elected. Thank you. That brings me to item number 3. That's to the remuneration report. Am I right? Yes, that is right. The remuneration report. The next resolution relates to the adoption of Cromwell's remuneration report for the year ended 30th June 2015. There is commentary relating to the adoption in the notice of meeting, which I take as having been read. The resolution reads that the remuneration report of Cromwell Corporation Limited for the year ended 30 June 2015 is adopted. I remind security holders that this vote is advisory only and does not bind directors of the company or the company. The notice of meeting gave details of the Corporation Act requirements in relation to the voting on the remuneration report. Voting exclusion apply for this resolution. Those exclusions are stated in the notice of meeting, which is taken as having been read. However, if any security holder requests, I'm happy to have the company secretary read the voting exclusion statement. Does any security holder request this? Nope. So the proxies are, as you can see up there. Would any security holder like to speak in relation to this resolution? You're entitled to speak.
This is why I get the big bucks. So I suppose the same general question is, there is a once again what I'd consider a fairly large. I mean, that's $159 million worth of votes against the resolution, and I just wonder if you've received any feedback about this particular proposed resolution.
Again, in relation to the remuneration report as a whole, we didn't. Is that right? You aware of any? Ross? Where's Ross? No. As a whole, we didn't.
I think, Jeff, one of the main topics, Malcolm, as you'd know, for discussion at all of these meetings is remuneration. In general, proxy advisors will take a view on remuneration issues, particularly disclosure around KPIs for STIs and LTIs. And the votes against reflect the positions recommended by a lot of the proxy advisors, who say that either better disclosure is warranted around KPI performance, or they don't like the schemes. So we don't have a scheme in Cromwell that provides a high level of STIs. We do have an LTI scheme. We don't provide substantial LTIs, and our LTI scheme is directed mainly towards retention. So we like to see people aligned with shareholder interests and holding shares in the company and building wealth over time.
Yeah.
But we don't regard the levels of STIs or LTIs in our remuneration scheme as so high that they should be dealt with in the same way as other entities that pay far higher rewards. And that's basically the differences that we have with the proxy advisors. And I know Jeff and our company secretary and Ross McGlade, our investor relations, spend time every year with the proxy advisors and explain our position.
Actually, this year, whilst we heard from one or two of the foreign institutions who were advised by proxy advisors and local, we never heard from proxy advisors. And anyone we did speak to decided to vote differently to the proxy advisors, which I can get to, and that only related to the next item, not this item. And I would imagine if there were some votes there, they all relate to the last item, which is crazy. Yes?
I have one question. Compared to the previous financial year, if you calculate it all out in dollar terms, what percentage increase or decrease in remuneration is being recommended in this report?
Well, the remuneration report doesn't actually recommend particular increases. It's just a report about the way in which we philosophically remunerate, if you have a read of it. No, so the remuneration report which we're talking is different thing. But across the board, we pretty much paid, across the board, I think it averages out to around just under 4% or so. Is that right, Paul?
I think it was somewhere between 4 and 5%.
Yeah.
Sorry?
About a 4% increase this year rather than the previous year.
Across the board.
Across the board. Yeah, but I think the point Jeff's making is that it's not an issue that people have with the level of remuneration. It's issues in relation to the disclosure around the award, particularly of long-term incentives, and the KPIs that must be met to achieve that. So, for example, a number of businesses require a total shareholder return threshold for long-term incentives to be paid. We have a test that says you must meet a KPI to qualify for an LTI, but then you must serve out a period in which those LTIs then vest. So given that Cromwell is a security that pays distributions and secure distributions, we're not focused on the growth in the business or a minimum shareholder return that we need to achieve. We're focused on providing a secure distribution over a period of time that grows at better than inflation. So the board and the Nomination and Remuneration Committee, in considering the structure of the remuneration, take the view that we're better to make sure people perform in a current year, and if they're good employees, hang around for as long as possible to continue to provide the support and the resources to keep those distributions going.
And unfortunately, the proxy advisors have a tick the box for all companies. So they don't actually say, are you a real estate company, are you an internet company, are you a manufacturing company? Now, if we had to reward our senior management in the same way, say, an internet company does, we'd be having to tell them that they've got to double the share price and things like that and not worry about the distribution. If we did that, you would have a very unsafe company and very short-term company, because they'd have to be buying and selling buildings very quickly and not worrying about the quality of the asset, the length of the asset, the security of the rental they get. They would buy a building probably very cheaply with a 1-year tenant and then hope for the best the following year, but then they get paid this year, but next year if we all lose money, they can just up and go because they got paid last year. So it's not appropriate for an AREIT, for a real estate investment trust, to pay in a manner that causes short-term behaviour. It's a long-term. None of you have bought your shares to see the share price automatically double. If that was the reason you bought the share, you're in the wrong room. You bought this share because you want to know that every quarter you get a distribution that's consistent, that's growing, and in the same time we're preserving the wealth of your share price, which means that's also got to grow proportionally, but it's growing in a steady eddy way. This is buildings we own. This is not, you know, things that we suddenly buy and sell and jump on the next bandwagon. So you must understand that, unfortunately, it's a sad truth. We will try and educate them. None of them spoke to us this year. It's the first time this company's ever had anything of that sort anyway, and only related to the fourth item, and it had nothing to do about the quantum of pay. It was about the fact that we didn't spell out exactly what the key performance indicators are for Paul to get his opportunity to get effectively shares in the company for work he did in that year. And by the way, by him getting shares in that company for work that year means he's going to now have an interest in exactly the same seat as any other security holder to make sure that we continue to pay our distribution timely and in a growing manner, and to make sure that the price doesn't go down, that it continues to also grow in a steady way. And so he's completely aligned. Why that's a problem, I'm not sure. Yes, Andrew.
Can I comment on the 15.79%? I don't think it reflects the position with Cromwell. I think it reflects a growing attitude among shareholders who say to themselves, my goodness me, 35 pages it takes out of the annual report to tell us about the schemes, and everyone sits back and they come up with excuses for the high salaries and the comparison. We need to compare it with someone, and they pick out 50 companies. We'll compare our progress against the top 50 companies, and 49 of those companies have probably got nothing to do with the field that they're in. And I think the thing is, over the years, it is getting out of hand. I don't know what the answer is. I remember when I was a company director, I was very pleased to be given the opportunity of having some shares in the company, for which I paid for them at the going rate, with an option of maybe having some more the next year if I did the right thing. And I think eventually, over the next 5 to 10 years, it's going to explode, and somebody's got to come up with a better, fairer scheme to keep the shareholders happy.
Yeah, but that wasn't what they were complaining about. So just, if we can just pass this one, we'll go to the next one. You want to? On the report itself.
On the remuneration report. So I just wonder, this is possibly just a auditing requirement, but we talk about the loan to Mr. McCarthy of $14 million. Part of the acquisition of Vlad Europe, the company there was $14 million payable to Mr. McCarthy, which he then loaned back to a subsidiary of the company, presumably meaning us. So is that transaction just a sort of a round robin, which won't have any bearing on the? Do you know the transaction I'm talking about?
Yes, but it's yeah.
Payment
deferred
of part of the consideration for about 7 months, so it's actually been paid.
So it'll show up in it'll be reported.
It'll reverse out.
But it'll be reported on in the remuneration report for 2016.
It's not actually part of the remuneration, because when we bought the business, a number of the executives in the business had equity effectively in the business, so they received part of the proceeds.
Meaning
Put simply, Mr. McCarthy was one of the vendors.
Yes, all right. No, I didn't understand. I didn't realise that. Okay, very good. And the other one, just on this subject, the Vlad, so that there were no payments this year under the Vlad Europe Performance Participation Plan. Would that be as at 30th of June?
We only owned it
because they all
for
get paid in August.
We only owned the business for the last few days. Part of July,
Since
August, September.
1st of April.
I thought it was February.
May,
Oh, I see.
June.
It's settled in there.
Settled 1st of
Settled,
April.
All right.
And but they have their own remuneration scheme which we inherited in
Yes,
place.
well, that was going to be one of my questions. And the other one was the, and you use this term in your report, a promote is a noun derived from the verb to promote, I take it, and so that there is a 40...
It's a term of art in the property industry.
Is it? And so that there is potentially payments of incentives of 40 to 50%. So is that sort of the super profit in a particular
Correct.
deal?
It's an LT, so it's a performance fee if you think about it.
Basically what happens is they do a deal for a private equity fund, and let's say the company is entitled to 20% of the upsides of a profit above a certain hurdle or something like that, which is only going to happen one day when they exit the property. So they exit the property, the customer makes a bunch of money, the company shares
Meaning
in part
Cromwell makes a bunch of money.
No, the customer, the client.
Oh, yes.
At that point, Cromwell gets a super profit fee,
Mm-hmm.
which is the promote, a super profit fee, and part of that super profit fee is actually given as the way they give a long-term incentive to the individuals who worked on the deal. So the people working on the deal, if it took, say, 5 years, they never got anything over that 5 years of the super profit, but when it came out at the end, they get a percentage of it.
Anyway, I'll study the report next year with great interest.
Are there any further questions, at least on the remuneration? We've gone through the proxies, okay. So I'm now going to actually a show of hands. The proxies aren't even all the voters, but that's besides the point. All those in favour, please say aye. Is there anyone against? No, it's actually unanimously carried. Thank you. Finally, item 4. This is the grant of a performance right and stable securities to the Chief Executive. Because Paul is a director of the board, we have to bring this, rightly so, to the security holders for you to vote upon. The resolution relates to the approval of the grant of performance rights and stable securities to the CEO. There is a commentary in the notice of meeting, which we've all taken as read. I'll just read the actual resolution before we discuss it. That approval is given for all purposes, including the purpose of the ASX Listing Rule 10.14, to the acquisition by Mr. Paul Wakeman, Chief Executive Officer, of 1, performance rights under the Cromwell Property Performance Rights Plan. 2, Cromwell Property Group staple securities on the vesting of some of all of those performance rights, and 3, Cromwell Property Group staple securities under the Cromwell Property Group Employee Share Loan Plan, on the terms of those plans and otherwise set out in the explanatory memorandum that accompanies this notice of meeting. There are voting exclusions that apply. If anyone wants to know, we'll let you know. And here are the proxies, as you can see. And to preempt your question, this was the one that we became aware. We weren't told, we became aware last week that some of the proxy advisors had advised against, and in each case advised against purely, not on the quantum, not on the amount being offered, not on the fact that Paul was entitled, but on the fact that we didn't give enough detail in relation to what are the key performance indicators which the board expects from Paul. We have told in the 2 or 3 calls that I was personally involved in, where the actual institution called me because they didn't understand why the proxy had highlighted this and they wanted to discuss it with me. All of those have subsequently told us that they voted in favour. The reasons, and they showed us this, that's why we didn't hear directly, we heard it from various customers, was that the proxy advisors basically suggested that we must be more open about what his actual key performance indicators are. We said we will definitely give more thought to being able to tell you what they are. But let me tell you, the CEO's key performance indicators are both hard and soft. So the hard ones would be things like in a particular year, depending on the year. So that's why we didn't print it, because you're not going to know what they are next year anyway. So you can't tell people. Is, for example, to make sure if we've promised you a dividend of X, that you get that dividend or better. If we've promised you that our performance will be Y, that he does better than that. If, for example, we buy a business like Valad in this year, one of his key performance indicators would be to ensure that it performs according to ways we were told it was going to perform when it was bought, etc. That may not be his key performance indicator the next year. This resolution relates to the next 3 years. It is not possible to guess what we're going to ask him to do next year to earn it. And in any event, the amount of performance he writes he can get is only up to a maximum. He only gets that maximum if he achieves everything, and he can get a lesser amount if he doesn't in each of those 3 years. So we found it very difficult to comply in the context of this thing with something which some proxy advisor wanted to know. The way why there are proxy advisors, which I know a few people have asked me before, so I'll share with all of you now. Why do they exist? Because there are people called hedge funds and there are people called institutions, where they have gentlemen, and usually very young ones and a few older, wiser heads around them, who buy 100, 200, 300 companies, shares. When they own that share at any point of time, all 300, they get notices of meeting. Because they don't read and want to go through every little thing, they send it to someone called a proxy advisor to highlight for them what they think is bad behavior or should be questioned on. The proxy advisor then goes through and reads those things on their behalf and comes up and ticks boxes where it ticks it and doesn't where it doesn't. They don't ask too many questions. They look if it looks like it ticks a box. They treat every company the same to tick the box. And on our case, we got a cross next to number 4, which is why there's that many of the proxies, which mostly represent international type institutions and larger institutions who don't do that much thinking for themselves in this way. And they got those. Sorry?
People who don't know.
Well, they don't ask questions. They don't even want to meet. They haven't even met him. So they've bought blindly. They don't know who they. So those guys send those proxy forms in, and that's what happens. The intelligent institutions phone the company and say, we noticed that the proxy advisor did this. We would like to understand why, so we can make an informed decision. We only use the proxy advisor as a red light for us to ask the question. We got 3 phone calls that I'm aware of, and all 3 then voted in favour. The others are the anonymous, effectively. So for the benefit of everyone, that's how the system works. Any questions? Yes, sir.
I mean, firstly, the Australian Shareholders Association recommends that our members vote in favour of this resolution, and we would like to see these institutional holders whose members of superannuation, mums and dads, have a similar profile to our own membership. So we say they should give their proxies to us, and we will come along and vote them. And then they don't need to pay the fund managers. But certainly, one thing I would say, the proxy advisors, then, but it certainly was clear to me that this was a resolution giving the board authority to, it wasn't seeking to issue any particular securities, and it was just a sort of a blanket authorisation.
No, what it's done, it's authorised us to issue up to $800,000 worth, $800,000 worth of shares at a certain cost that Paul would have to pay for those. It's a discount to the normal price. In each year for the next 3 years, if we so desire, if we thought it was an appropriate way to reward him, and at the same time to ensure that he can't get any benefit out of selling those things for another 3 years. So he's held in the company by them. The crazy thing, and this is where it really gets crazy, because now you got me going. Where it gets really crazy, if we had decided to write Paul a cheque on your behalf, if the board decided, you know what, we don't want to go to meetings and get people's permission, we're going to write him a cheque, give him cash like other people do, for, I don't know, $2 million, $3 million in any 1 year, guess what? We don't need anyone's approval. Now go figure. We don't need anyone's approval. But here we are asking you, we are trying to reward Paul in a way that puts him in the same seat as our security holders. So he thinks like a security holder, and he's a very large one in his own right with his own hard-earned money that he's paid over the years. And we want him to continue to be like that, and we do this with a number of our senior employees, because we want them to think and behave just like our security holders who care about security price and dividend. And this idea that if the board wants to just write out a huge check, which is why the remuneration thing starts to be complained about, and then you can only give 2 strikes over 3 years to move the board, which has nothing to do with whether you can block the person getting remuneration that year, happens. So go figure.
Got the message.
Yeah. It's a bit like accounting standards. Go figure. All right. So having said all of that, and sorry if I use this as a soapbox, would any security holder care to move item 4? Thank you. And a seconder? Thank you. All those in favour? Thank you. Anyone against? No. I purposely didn't vote only because I didn't want anyone to accuse me of... So, thank you very much. Unanimously approved. Now that we've dealt with all the specific business, I think I'd like to invite you all to come and join us for some refreshments. Feel free to mingle and ask questions of our auditor, of any of the directors. Once again, I would just like to thank very much Robert Puller, Robert in particular, for everything you've done for us, and we're going to miss you at the board meetings every month. And again to Daryl, it's great to see you again, Daryl, and wish you well in your new career as a fund manager. All right, thank you everybody. Thanks.